Treasury inflation-protected securities are often called TIPS for short. TIPS are a type of government bond that accounts for the fact that prices of goods and services change over time. They call this inflation. Let's look a bit closer. First, let's imagine that you bought $1,000 of a typical 30-year Treasury bond, and this bond pays interest at a rate of 3% per year. This is called the nominal interest rate. Nominal simply means the interest rate you receive before inflation. If you adjust the interest rate by inflation, well, they call this the real rate of return. So you can calculate the real rate of return by simply taking our 3% and subtracting inflation as measured by the Consumer Price Index, often called CPI. So if the CPI shows that inflation went up by, let's say, 2%, well, our real rate of return for these government bonds is just 1%. But here's where it gets interesting. To illustrate inflation movements, here's an actual chart of the CPI since the 1950s. And yes, inflation went a bit nuts in the 70s and early 80s, but you can see that inflation hit almost 4% as recently as 2011 and 5% in 2008. So what are the alternatives? This is where TIPS, or Treasury Inflation Protected Securities, step in. You can buy TIPS for 5, 10, or even 30-year terms. But let's stick with our 30-year example. So you invest the same $1,000 in TIPS. And let's imagine that this 30-year TIPS will pay the same 3% as the regular bond. It wouldn't, but we'll come back to that in a minute. So you pay the $1,000. This has a few names it can be called. It can be called principal or face value or even par value. So the face value is the amount that's going to be paid back to you when the bond's life ends. In this case, 30 years from now. The 3%, well, this is how much needs to be paid to you, the investor, each year. But government bonds actually pay interest twice a year, so that 3% on the $1,000 is $30 per year, which is $15 every 6 months. Simple enough. Now this math is true for both regular bonds and TIPS. But what about inflation? So let's imagine that after the first year, inflation was 2%. Well, what makes TIPS unique is that the face value, in our case the $1,000, is adjusted by the inflation rate. So now our face value is $1,020. When you buy TIPS, the interest rate you received when the bond was issued is locked, but the interest payments paid is a reflection of both the fixed interest rate and the face value of the bond that is adjusted with inflation. So now the 3% interest payment the government owes you is $30.60. Divide that by 2 to account for the 2 payments in a year, and you get $15.30 for this semi-annual payment. So what's the catch? Well, first off, in our hypothetical scenario, we had both the traditional 30-year bond pay 3% and the Treasury inflation protected security pay 3%. The only way this would really happen is if inflation is expected to be 0%, and that's extraordinarily unlikely. Sticking with more realistic numbers, it's more likely that inflation is expected to be, let's say, 2%. This would mean that the traditional bond would pay an interest rate of 3%, while TIPS would pay an interest rate of 1%. This accounts for the expected inflation rate. So with this in mind, are TIPS worth it? Well, it depends. What's the average inflation rate for the life of the bond? If the inflation rate over the 30 years averaged more than 2%, which is the initial spread between the traditional and TIPS, well, the TIPS would have a greater total return. If the average rate was less than 2%, well, the total return would be less than traditional bonds. If inflation was exactly 2%, well, the total return would be the same. They call this 2% the break-even rate. Now, what about deflation? Deflation is when the inflation rate is negative. Well, if deflation occurs, the bond value decreases. So if the face value was $1,000 and then the inflation rate was negative 1%, well, the $1,000 would fall by 1% or $10. So now our face value is just $990. And let's imagine that deflation stuck around for a little while. And although you invested $1,000 at the start, your TIPS term is coming to an end, and currently they have a face value of just $950. What happens when you go to get repaid your bond's face value? Well, the government will repay you the full $1,000. The rule is that you will be repaid the current face value or par value. Par value is the initial face value of the bond, in our case, $1,000. So if your face value had climbed all the way to, let's say, $1,200, and then deflation occurred, knocking your face value down to, let's say $11.50, well, you will be repaid the $11.50 since that is higher than the original par value. And for our final point, let's take a quick look at taxes. With either TIPS or traditional bonds, your interest payments every 6 months are subject to federal income tax. But with TIPS, the adjustment to the face value due to inflation is also subject to tax, which means that if inflation was the original 2% we mentioned, and our $1,000 face value was adjusted higher by that 2%, giving us a $20 gain, well, we will be taxed on that $20 gain, even though we will not be given the $20 until the end of the bond's life. They call this phantom income. If deflation occurs, well, our phantom losses can now be used to offset our taxes. If you have any questions about the world of investing, any suggestions on videos, please post in the comments below, and please subscribe as we continue to update with new videos every week. Thank you.